Hello and welcome to the Asset Nivesh channel. So, what all data points you look at when you select a mutual fund to invest in? We at Asset Nivesh will look at both qualitative as well as quantitative aspects of a fund to suggest one. So, in qualitative aspect, we'll look at funds house and the portfolio characteristics such as sectoral holdings, stock holdings for a equity-based mutual fund, for example, and their prospects based on macroeconomic and other relevant information. In quantitative aspect, we look at funds historical returns, P/E ratio, expense ratio, etc. Now, historical returns aspect in mutual funds are really interesting. So, usually we look at three types of returns: annual returns, trailing returns, and rolling returns. Annual returns are calendar year returns, like returns in 2021, 2022, and so on and so forth. For example, Tata Small Cap Fund has annual returns of 33.23% in 2024 and 35.63% in 2023, and so on. The trailing returns are usually the CAGR between start and end date. So if you want to know the CAGR for this fund for last 5 years, then it is 36.54% annually. To calculate this, we have the NAV for this fund on 8th of May this year and 9th of May 2020, which are 40.03 and 8.43 respectively. So it comes out to be 36.54% compounding annually. These are point-to-point returns. Now let us discuss rolling returns, but before we look at rolling returns, it would be interesting to look at the limitations of other types of returns that we already discussed. By the way, you can also compare these returns with the fund's benchmark returns as well. Now, annual returns will tell you how much it is on an year-on-year basis, but it cannot tell you over a span of 3, 5, 10 years. So, you might have invested in a good year or a bad year, and you will thus carry a wrong perception on a long-term basis. Recency bias is one such fallout. In case of trailing returns, you get a comprehensive picture over a longer span, but now you miss the point of how stable that CAGR has been throughout the 3, 5, 10-year period. Enter rolling returns. The rolling returns reflect on the consistency or probability of return for a given investment period. So if you want to look at what is the probability of return being greater than 15% in 1 year, then you would draw a 1-year rolling returns chart for every month or every day for last 3 to 5 years and see how many times the return has dropped below 15%. If there is a zero occurrence, then you can assume that there is very bright chance that you will achieve a 15% return if you stay invested with that fund for 1 year. A financial advisor can explain all these, so better get one. Thank you. Speak to you again later. Bye.